I think the biggest pain point is not understanding the pricing, to be honest with you. I think there's a lot of advisors that look at, let's say, a structured note that's developed to where the underlying assets are individual stocks, okay, versus the structured note where the underlying assets are developed markets. There's a lot of time people look at them and go, no, these are like, they look at an individual stock basket and it's returning 15, 20% or whatever it might be per annum. And then a developed market one they look at and it's maybe returning between 7 and 9%. And there's always the question of, well, why would I use that one versus this one? And it's just the whole understanding of the risk versus reward of the two, or of notes in general, is what advisors really don't get. So when you look at developed markets quarterly income note, for example, for, let's say if you've got a European barrier at 60%, okay? So that means for that not to work and for the client to lose money, those underlying assets would have had to be down 40% over a 5 or 6 year period or whatever the term is. Tell me an occasion where that's happened in the last 25 years. So like the only occasion where it's happened recently is the Hang Seng, which it happened over COVID. There was one of the biggest property market crashes the world's ever seen. Yeah. There's geopolitical tensions with Taiwan, Hong Kong, and then also COVID-19, which is the biggest pandemic we've seen. So it's like, okay, yeah, kind of understandable as to how that happened. That's not a structured note problem, that's a Hang Seng problem.
Yeah.
And I think that's one of the biggest things that people don't understand is when you look at the S&P 500, the Euro Stoxx 50, the FTSE 100, the Swiss markets, they haven't had a period of negative 40% over kind of a 6 year run since the early 90s, basically. Okay. So I think that's one of the things that people don't really understand is the risk versus reward. The risk is relatively low on developed markets for the reward.
Yeah, for index, right? For index linked with the diversified equity indices, right? Because if you go to single stocks, that's slightly different.
Definitely, yeah. And I think they're very popular in especially India, from my experience, and also in the UAE, are single stock notes. So when you're comparing kind of apples for apples, it's impossible because apples for apples is not the same thing. It's the same as comparing like mutual funds and the underlying assets within them. They're often completely different if you're getting wildly different returns. They're not invested in the same thing, but because no one really takes the time or care to look into the underlying assets within a structured note, the historical pricing of them, and then also the back testing of them, it's something that gets completely forgotten about. And they just kind of go, not really worth it for 8% because my client could potentially lose 40%. If your client were to lose 40%, we've experienced some massive crashes in the markets, which over a 6 year period as well. So it's like there's a lot of things have to go really, really wrong for the structured note not to work, basically.